You fucking dork.
Yeah, I know.
It's the thread that intertwines us all, is that we're all actually dorks.
Change this banner on the stream. All right.
There was a username I saw that just popped into the audience. Gator don't play no shit.
That's amazing.
And then they just quickly left. Oh, they're back. A Gator don't play that. That's fantastic.
That is a great name. How's everyone doing? All right. I think we have all the streams up and running. Maybe. Yep. Looks like we're live. Oh, we gotta share the links. I need all the links. Shit. Wind down? That's not what this is about, Thunder. You had a chance to ask that literally 30 minutes ago when I did the end of day stream. All right. Get everything set up. How's the share my screen in here?
I'm just getting up my script. Don't say penis, don't say penis, don't say penis. That's all it says on it. Okay, cool.
You
penis.
Just...
Damn it.
No, you did it anyway. You tried so hard. Why is the stream on so early? This is, well, it's a little early. The event starts at 8 p.m. Eastern.
Yeah, we wanted to work out the technical difficulties and palpate everything before we actually got into it.
We actually thought if we started it 20 minutes early, JFresh would only be 10 minutes late. I'm in the middle of my day job. Where the fuck do you work? Are you live in Hawaii?
On the West Coast? Or Hawaii, yeah. Or Alaska. I'm guessing West Coast, though.
Yeah, it must be. That's the idea. Now you can watch us on your way home. That's correct, Thunder. GammaStrike questions are preferred. Win merch. We're working on it. It needs to be the finest bespoke merch, first of all. And then also, it needs to be cool. So it's a lot of effort that none of us really want to do.
What, merch?
Yeah.
You know, Girk, you got some merch that I would love to have on my dome piece right this fucking second.
You mean the giant box of hats that don't fit me?
You son of a fucking bitch. Yes. Goddamn hats.
I do have them. I'm looking at them right now. They've been in my office for well over a year.
I'm waiting for you to take a picture of the ball gag wrapped around the box with like a pistol pointed at it.
Are we going to use that for our socials?
That's exactly right.
We should give them away to our most committed subscribers.
Dude, I would love to make little swag bags with like the shitty ass mints, you know, that have like the GammaStrike logo on the lid, you know, and it's just shitty mints that mostly are sugar.
Oh.
Like that kind of stuff.
We need to investigate if we can get like some company in Germany to like press like GammaStrike ecstasy tabs. with
For
the appropriate,
GammaStrike LSD sheets.
yeah, with the appropriate color gradients.
Oh my god. Well, the GammaStrike butt plug was a great idea with like the ball bearing so you could spin the logo on the bottom, you know?
I know.
We should actually do that. I don't know who we hit up though. Is that something we have to like get to who's that called? Like a something cut something?
I have no
Those
idea.
guys, or I don't know who does silicone molding, and then we'd also need to get a ball bearing that fits in there.
Oh, is it going to be a silicone butt plug? I thought we'd go with stainless steel.
We could go
Because then
stain.
we
Well,
could
the
just
thing with
have,
silicone.
then we could have Popcorn Trader make them for us.
Well, the cool thing about silicone is then we could do like a multicolor, like a tie dye in GammaStrike colors.
That's a good idea.
Yeah, you see. Or we could put your face on the tip of it.
You know,
Is that not blowing your skirt up, Girk?
yeah, I'm trying to think that like it might be a little uncomfortable.
For you or for them?
My face is not that aerodynamic from the front, you know? Like, I guess it depends on how detailed it is. Are we leaving the beard?
So I would assume that it's only like some very mild facial like outlines. So like your ears and your nose and stuff would just be like a little bit of a dimple, not really like fully like detailed like
I
that.
see.
Because that would
So
be
it's more of a tickle than like a kind of like a something. But you just don't want it to catch, you know. I'm
yeah,
thinking
no,
that
it
it
would be
would.
more like a which way is Girk facing when I put it in.
What if we just sell one that's like where the spinner part is my face?
I love it. I mean, you could do that for the Pi-Fi merch shop,
Can
but
we? Can the butt plug vibrate when SPX hits important levels? Yeah, that was the whole plan. Is we were gonna tie it to the notification system in Gamma Strike. So
it'd
you'd
be cool
hook
if
it
people could
up to
log into
the
their broker on it and then just like when they start losing money, it starts vibrating.
ooh oh like and it gets more intense the deeper your drawdown.
Yeah. Or the
Interesting.
other way around, right? That sounds like it might be positive reinforcement for bad trades. So we may want to do it the other way.
Depends on the person. You could probably make a really unpleasant vibration sensation.
Oh, right, like one of those like weird like warbling ones.
Yeah,
Although everyone's into different things. Like, yeah, I think the taser, maybe we have a taser.
maybe something more like a jackhammer
Mm,
where it's
there we go.
or like the Xbox, the original Xbox 360 controller.
I was thinking kind of like the episode where Butters is abducted by aliens or something, and then like he's like all traumatized, and they want to find out how much trauma he's experienced, and so they put him on this big machine that just basically rapes him.
Well, that's great.
We just use one of those, turn it into a trading console.
That's it. Okay,
You
no
sit there
more
going,
talking for Dork.
you don't remember that episode? It was like season
No,
1.
I've told you 8,000 times that I don't watch South Park.
Oh my! You got to watch that episode. It's so funny.
I don't want to. Now that you've described it, I want to watch it even less.
You're just uncultured. All right, I get it.
Yes, I'm the
I accept
uncultured
it.
one.
Yes, that's right.
I wonder if
BRB,
when
I'm getting some
JFresh
pineapple juice.
unmutes, if his mic will work.
Ooh, are we gonna take bets on that?
I'm just waiting for you guys to get started. You guys do this one. I'm tired.
What? No, you're doing this one. This is your favorite thing. Volatility's price, guys.
You got it. All right, my work here's done.
This is a price page.
Yeah,
I'll
it
be
tells you
right
the
back.
price.
Are we still waiting for viewers to slowly filter in?
When have we ever let that stop us?
Yeah, I mean, I guess we don't need anybody to be here yet. We can just start blowing smoke up our own asses.
Isn't that what we do anyways? Fuck it. Let's go.
All right, Dork. Explain the page.
Well, I got to do the introduction first.
Okay.
Welcome, everybody, to the GammaStrike Roundtable. We are doing a cool thing where we go through every page from the bottom up. And we're doing this as a way to get everybody caught up and create a nice little point of reference for people who are GammaStrike curious, want to find out about the tools, learn a little more about how they work and about how they fit into the market. So yeah, we're going to do a little bit of a jump into this thing. And then at the end, we will be answering questions. So wherever you're watching this or listening to this, feel free to throw in a question and we will throw it in the list and get to it at the end. So this page is the volatility page. As you can see, it's got 1, 2, 3, 4, 5, 6. It's got 6 panes on it, man. It's super cool. So in the top left, you've got a few little IV and HV gauges. IV stands for implied volatility. HV stands for historical volatility. And what those numbers tell you is, the past performance of the market and the future performance of the market, the expected future performance. So implied volatility tells you where the market is predicting the stock or equity will go up or down. Historical volatility tells you where it did go up or down. And this implied volatility gauge measurement is right at the money. When you move down, you see implied moves. The implied moves are on 1 day, 5 day, 30 day, and 45 day. What these implied moves tell you is it's basically a conversion between the at the money IV that you see above to a 1 standard deviation expected range below. So, those implied moves are basically where the market is saying, hey, there's a roughly 83 or 85% chance we're going to stay within this range. In the bottom left, we have the broken out implied volatility surface. And that's essentially just showing you the whole entire kit and caboodle.
Well, hold on. Hold on. We can. Are we? Oh, we're just gonna describe each one.
I was just gonna hit the features really quick, and then we can jump into context and all that.
Okay. All right. That sounds great. Yeah, keep going.
Okay, yeah. Volatility surface. It's a volatility surface. You can spin it, you can zoom in, you can zoom out, you can do whatever. It's got a white line and a green line on it. The white line is right at the money. So the IV10, IV30, IV60, IV90, you basically just go on that white line, pluck out the number, put it on that gauge. The green line is telling you where the lowest volatility is. So you can actually use that to sort of gauge, I guess, a sort of expected path of a given equity or index. The next pane, we call it the implied volatility term structure. What this is imagine if you took a sheet of paper and slid it right through that volatility surface and it was pointing down the expiries, right? So you take that sheet of paper, take a slice out of the expiries, and you get this curve out of it. And when you slide the term structure around, you're sliding around strikes. So you can sort of see how the different strikes have this different curve to them. I think it's a pretty dang neat tool. The next one over is the classic implied volatility smile. This is one that you probably all know and love. This is the most traditional way people look at implied volatility is with this smile. So those are those bottom panes. And then in the top right, we have a time chart with the values you see on the gauge on the left, as well as a few extra values. So besides your classic IV and HV over time, you also have these SK10, SK30, SK60, and SK90. Those are measurements of the skew in the volatility smile. So those tell you whether or not calls or puts are more favored in terms of price on the actual volatility smile. So if it's more negative, puts are more expensive than calls. And if it's more positive, calls are more expensive than puts, assuming that the contracts are out of the money. So essentially, higher than spot is favored if skew is high, lower than spot is favored if skew is low or negative. So those are those additional values. So you can use these tools to do, sort of historical analysis on, you know, market expectations after certain events, things like that. And you can view them together like Girk is showing now. Yeah, so this is your historical view set of the different values you can get from the implied volatility smile.
All right. Well, that's a great start to all of this. So I guess we could go like tool by tool, and kind of go over what each one does and how we use it. I could kind of start with the first one, these gauges. So these are, we're looking back at we're looking at current IV relative to its last 10 days or 30 or 60 or 90. And then we're looking at HV in that same window. And the kind of useful thing for this that you don't really necessarily get out of using this information over here, which we'll get to later, is that you can make like a really quick, like kind of offhand comparison between like IV10 and HV10 and see if over the last 10 days, options are priced fairly or unfairly to their actual realized volatility. And this is frequently what I use it for, is it's just like a quick glance at like, IV is in like the 13th percentile, whereas HV is in the 11th over the last 10 days. Is that an act? Well, I guess it's not really.
No, those are just the value. You're talking about the gauge itself.
Yeah.
We're in the 0th percentile.
Zeroth.
IV and HV fucking tanked.
Yeah, that's fair. Relative. Well, they've tanked over the last 10 days. This will start to, as HV starts to bleed in the front, these will start to fill back up again and things normalize. But yeah, we have a massive drop in IV over the last few days. But, IV is a little higher than HV here. And then I use that gauge to make a rough comparison of, how much higher it is now than it's been over the prior time period. Like right now, HV30 is very high, whereas IV30 has tanked. So, there would be some expectation that way. That IV30 is going to move up to catch HV30, since options 30 days out are a little bit underpriced relative to like how they have performed. And the same is true out here with IV60 and 90, which obviously haven't dropped as much as IV10 and 30, but they are fairly low. Well, IV90 is fairly low. IV60 is actually kind of high. So just an idea of how to use those at like a quick glance. And I don't know, JFresh, do you have anything on these? They're fairly simple.
He ran away. They are very straightforward. The gauge itself is like a percentile, so you could look at IV60 there and say it's right around the 50th percentile. The HVs are absolutely juiced still because there hasn't been a lot of time, and HV with like really fast events that like happen super quickly, they tend to spike and then hang out for their time period. So they're interesting, but you'll watch as the HV30 and 60 and 90, and you can do the historical analysis on the HVs on the chart on the right to kind of see this play out when there's like a huge gap in the market or something. You'll see those values like jump up and then come back down over their measurement period, and that's just the nature of how they're measured, right? That big move is part of the data set until it falls off. So no. Yes. I thought you yelling at me. Yeah, so you can do a historical look back on the HV6090 and all those. Go back to like when there was like a big CPI print or something, and the market moved a whole bunch, or like a Nvidia earnings, which the market moved a whole bunch, and you'll see, oh, it jumped up, and then 60 days later it went back down. So that's kind of why those are going to be kind of pinned up there at that high level. They may fluctuate a bit from the high level, but they'll be pretty much stuck up there for a while, and then they'll drop to some percentile that makes a little more sense. Yeah. And then I know that, and he had to run off to yell no at someone else, but I know that Girk wants to talk about the implied move, because that one is pretty neat. So for day traders and those kinds of, oh, he's back. Do you want to talk about implied move?
Yeah. We can talk about implied move. So
I know you're a fan of it.
Yeah, I'm actually a huge fan of it. Well, I like it as, just another kind of support resistance level, because it has a bit more mechanical meaning in it. Sorry, my cat just fucking totally bowled over my TV. It is. I'm 90% sure it's broken this time.
God damn it.
He does like what's that thing where like the people like they like run through the streets and like jump off stuff?
Oh, parkour?
Yeah, he like parkours. So he runs down the length of the couch, jumps, and then like wall plants the television, and then like ricochets off of it. And by doing that, he knocks the television over.
You should wall mount it. That way it won't fall over. It'll just get cracked.
It's free floating. I can't wall mount it. Anyway. So implied moves, I mean, it's a great tool to use. It tells you what the market maker is pricing in to the options over that time period, like how much range, and all of those ranges are plus or minus, so it doesn't tell you anything about direction, but if you have an intraday move, say you have you look at your implied moves, which are pretty direct over the next trading day, and you get into that trading day and you see the market will trend to one of those moves, test it, you'll frequently find that acts as support. And there's some reasons for that. It's because, at open, options were priced fairly. And then as that price moved up or that price moved down, those options remained priced fairly until it reaches or exceeds that implied move. And then those options are now too expensive, or these options are too cheap. And so what happens is you tend to get a lot of profit taking at those levels. And you get a lot of options selling at those levels, because, when those options go up in value relative to how they were priced, people are going to want to sell them. And that can mean sell to close or sell to open. It doesn't matter. They're going to sell them. And where this tool becomes really fun is if you get overnight moves when the options market is closed, and say people, this was spot, and then these two bands are the implied move, and the market opens here, everybody's going to want to immediately sell off, because their options are priced now. Like, all those options are now priced. All the calls in this instance are priced much, much higher than they were, than what was paid for them initially. And so, it tells you a lot about incentive relative to pricing. Same thing if the market opens very low, the market will be encouraged or incentivized to move back to that level where once again options are priced fairly. And dealers can further incentivize that by adjusting the IV of these options in order to get people to sell them. Because they want them off their books because they did not price them correctly. And so everybody, the dealers and the participants, are all encouraged to kind of obey the prior pricing from the previous day. And another cool way to use this is to look at like what the market maker is pricing in over longer time periods without just focusing on the 1 day implied move. But like if you're selling options, this is a very useful tool because you're not going to want to sell options within the range that the market maker is pricing, because those options are, you're not going to get as much premium off of them, and you have a greater risk of them going in the money. And so by using this to kind of adjust things like condors and butterflies, you can find ranges where you're less likely for that sold option to go in the money, and you have less hedging and stuff to deal with, things like that. So basically, and it also tells you like those options are cheap relative to this move specifically and at what price that move exists at.
Yeah. So like I said, there's the implied move, right, is essentially, I think it's actually closer to 70%. The implied move says there's, the market has priced in a 70% probability of price staying within that range at this reading of implied volatility, right? So right now, this very second, right, SPXW, which is the weekly SPX, has priced in a 70% chance we're not going to move outside of a 1.4% window over the next 5 days, right? So that's kind of what that's saying to you. So to give you an idea, like as a risk analysis tool or anything like that, that would be a good way to think about that is how the market is, like what the market is pricing in terms of volatility.
All right, and then is JFresh still not back?
No, he's having some testicle difficulties.
What did he do to them?
He must have punched him.
Did he send you a picture?
Yeah, I don't want to remember it.
Oh.
Yeah.
Are they bruised?
Dude, it was like, it was kind of like, Steve Buscemi? Is that his name?
They looked like his face?
Yeah, like the top half of his face. It looked like what I was looking at.
But like Steve Buscemi after Steve Buscemi's been beat up, or just
yeah,
Steve
it was like
Buscemi?
Imagine, Rocky 1 where he faces Apollo Creed?
Yeah.
Now replace Rocky's face with Steve Buscemi's face.
Okay. So like certain spots of it were like swollen to the point of being like smooth, but other spots were Steve Buscemi's face.
He even had that weird little cold compress they use in boxing matches on one of them. It was, I don't want to remember it.
That's pretty horrific.
He may be shouting Adrian. I'm not sure.
All right. Well, next up we have the volatility surface, which isn't going to be here for long. So enjoy it while it lasts. I will actually want to make a
It's
note
going to be
about
better.
Yeah, I want to make a note about this entire page is going to be changing soon. So we'll probably at the end of this be doing another one of these to cover the new features, or maybe a shorter one to cover the new features that we're going to be adding to this page. But this is the surface. This is the expression of everything you see in this window and this window, but as a 3D plane. And so these are slices of that window at each strike. And these are the opposite slice of that window at each strike. So here you're looking at this at the money, like sideways. Well, I guess we go like this, right? It kind of looks the same. And then at the other way with the smile, you're looking at looking at a slice like this. And so each day of that slice would advance you one forward on this. And so, this is probably the tool most people are familiar with seeing with volatility, aside from the smile. I would say it's the second most used tool. There's two lines that really matter here. One is spot. That's your white line that's kind of going off into the distance there. That one's pretty important. And then we have another line, this green thing here, which is the minimum implied volatility at each strike. And that kind of tells you where the market is expecting spot to be. So volatility is always lowest wherever spot is, with some rare exceptions. But usually volatility is going to be lowest at the money. And so this is kind of telling you what the market is pricing at the money to be over time. And on SPX, this is almost always up, and then further up out in the future. And basically it's telling you, it expects the market to move up that much, which, is not 8,000, over time. And then once you get way further out, further out into 2026, you'll start to see that pricing goes up. And part of that drift you're seeing there is just the way options are priced over time. And as this advances, those levels will fall more in line with the line you're seeing. But it does give you a good indication of, how the market views that chain moving over time.
May I interject with a cool conceptual piece of this?
Yeah, I would love you to.
Okay, so remember what I was talking about with the implied move and how it's what the market is pricing in for expectation of index or stock movements. That green line signifies where the expected move for this index or stock is going to be the smallest. Right. So that's another way to think about that, right? The minimum point of IV is where the expected move is minimized, which is why it could be considered to be a sort of expected price, but it's not a price prediction necessarily. It's where price is expected to be least variant. And you can look at those prices on the term structure to sort of get an idea for, what those IV values are at those expiries. And you can use a handy dandy calculator to figure out sort of what range around that minimum IV you would be sort of looking at, right? And yeah, Girk's showing you how it kind of rolls like a...
You're looking at this
like
low point almost there, and you're watching how that low point moves over time.
Yeah. So that's something that to point out too, is that it's not an expected price necessarily. It's the market's expectation for a price range with a 70% probability. And it will, I forgot the addendum too. You notice how the green line converges back to spot towards the closest expiration. And that just has to do with the fact that there's not a lot of room for price to move right before that expiration. So it all, ways for you to reason yourself to these things. That's kind of what I'm going after, is some of that intuition.
Yeah. It's cool stuff.
It is. It's super cool. Like when you realize kind of what these things are signifying, it's kind of mind blowing.
And then we have the smile, which I'll let you do because I know how much you love it.
I mean, what's there to say? It's a smile. It's a slice.
Sometimes it's a smile.
That's true. That's true. Yeah. Sometimes the smile can get kind of wonky, right? So if we go to a less liquid stock, let me think of a good one. What, like Upstart?
Yeah, Upstart's probably all fucked up right now.
Probably. Let's see. I hope it's not beautiful.
It's
you see, it's got some kinks in it. It's a little Wayne Gretzky smile going on there. Yeah. So with these other stocks, and there's not a ton of strikes on this chain, so it gets really fucky. But what you can do with the smile is you can sort of identify where the smile itself is sort of not exactly behaving like a traditional IV smile, which has the curves up towards the far out of the money strikes. Right? Maybe let's see if we can find a fun stock that has something
Oh,
kind of
here's
like this. You
one.
can look at. Oh Jesus. How about Apple? Apple's got a little bit interesting stuff in the nearest expiry. That's a little more traditional, something people might have. So you notice that kink on the far left of the IV smile, and how to the right of the smile, IV is also pretty low, right? So those two low points on the IV smile tell you that not only is the strike where the green line ends the expected range for the market's prediction, but the one above it is right there too, and it's probably an effect of spot being right between them. And that that would also explain why it's slightly higher, because spot's slightly closer to the lower one. But interesting stuff nonetheless. But when you look at that 200 strike there, you notice that IV, the line kind of takes a little detour, a very slight detour from the curve up, and then it kind of kinks back down. That's something interesting too. It tells you that the market may have a little bit more interest in the 200 strike, and that kind of suggests to you that there's interest in that strike. There's some sort of buying, either calls or puts. There's some buying happening there. And so that kind of dovetails into the whole idea of
You also have you
IV.
have that a little bit here too. This is a little
Yeah, a little
sloped.
bit. Yeah, just a tiny
Yeah.
bit of stuff here. Yeah, so you can sniff that stuff out. So let's say you're a buyer of Apple at 200, right? And you see that little kink in IV. That might suggest to you that you may want to consider, short dated buy rights and just, put that cash to work. Because it's Apple, your yields are obviously not going to be incredibly stellar, but that's something that you'd definitely be thinking about, because you might get a very,
And
very slight advantage if your fill is
you can definitely tell
favorable.
that participants are not nearly as excited about the upside as they are the downside.
Right. Yeah.
Yeah.
And you could see that in the skew, right? That's another thing too, is you can look at the skew and kind of see, okay, because skew is a very even measurement where you sort of look at the pricing of these options based on where the market says there's a certain probability of them going in the money. And because of that, you can tell that, yeah, there's a favor towards the put side right now. It's recovering, but it's still put favored. And if you expect skew to become positive, and you want to put some cash to work, but you are a buyer of this stock at a certain price, you can use those values together to kind of figure out, okay, am I not only a buyer of a stock at price X, but am I also an option seller at skew Y? Right? Maybe you see that kink at 200, but skew is positive, right? That may tell you that you might not get what you want from the sold put. So the smile and the term structure and the volatility surface and this historical tool can give you an idea of whether or not the price that you're looking at is fair and maybe even advantageous. So you can kind of use them all in conjunction in that sense. But the
Yeah.
smile itself is just cool, because you could slide around it, kind of like the term structure. It doesn't quite have that rolling ball, but it does.
Well, that's
kind of give you
because
an idea.
IV flattens out into the future. So,
Yeah.
this like the further away, if you look at it from like this side, you'll see that and think about kind of the inverse. I'll show you guys this is the outermost edge that you're looking at there. And then as it gets
What's
closer
that
to
kink
us,
there? What's that
where
kink? on the surface. You see that kink there?
Yeah. Where
What,
the
is that
money
earnings?
the at the money IV kind of bumps. It probably is. Yeah.
Yeah, let me see
Yeah,
when
because
earnings is.
that's where the event risk is. It's
Yeah,
out
so
on
just
like
it's a
yeah, like May 1st.
that's such a I just that's such a cool thing to be able to see in the data right there is the market saying at
This is
that
where
very
earnings is.
specific point in time we're not exactly sure what's going to happen. It's so cool.
That's the only way I even know earnings exist, unless people ask me about them.
It's the beginning of May, yeah. So that's
Yeah.
definitely the contract for it's the contract after earnings that has
Yeah.
elevated IV. So that means the market is pricing in a premium to buy or sell contracts at that. Well, yeah, buy or sell contracts after earnings, right? So if you were trying to be a buyer at 200, maybe earnings gives you a chance to, get a little bit of a discount on that buy right at 200.
Yeah.
So yeah, and this kind of all connects to the fact that IV dictates the price of the option, right? It is the price of the option. It doesn't dictate it. It is the price of the option.
Yeah, and a fun thing with the IV smile and the representation of skew there is that skew can be a really great way to find good entries into stocks, especially ones with like liquid, like Mag 7, things like that, with very liquid options chains where, the sentiment in the options chain is going to reflect the sentiment of the market, like 1-to-1 or closer to 1-to-1. If you look at Apple over the last 5 years, and I don't need to look at the price of the stock, I can tell you that anytime puts got very expensive, like skew fell below 30, if you had bought Apple, you would have made money. And you would have made quite a bit of money very quickly. Somebody can go check, but like on 10-2, obviously, obviously March of 2020, but even these, like 5/24, 2023, or oh god, can I zoom in on that more? 10/24, 2023, or 8/4, 2024. And you can go look at all of those. 4/12, 2025. Definitely, that was the post Liberation Day crash. But also, even these smaller ones, like 8/21, 2025. And you can go back and look at the performance following that of Apple, and it's probably going to be really good.
Yeah, and this is how this can tie into, maybe you're not necessarily an option trader and you may just, have companies you're interested in investing in. Skew can tell you sort of it is a sentiment indicator for the market. So you can use that as a tool to help you with a DCA strategy on a stock you may be interested in. So, perhaps like a Caterpillar or one of those things, maybe economic, outlook is souring, but that there's going to be a good harvest and people are going to be fixing their Caterpillar machines. You can look at that skew and sort of tell relative to the past how sour is sentiment right now, and determine if the iron is hot enough for you to strike.
Yeah. And
Yeah.
well, I guess just a quick moment to let anybody know, if you have any questions, we will be doing a Q&A at the end of this, so you guys can drop those questions in chat, whichever platform you're on, and our producer Ron will be running around and grabbing those and collating them for us in one place, and we will answer them at the end of the discussion. So do that, and while you're at it, make sure to drop a like and subscribe so you see any new content that may be coming out from us.
Sorry, I interrupted your shillery. Yeah, like and subscribe.
What the dick?
I'm sorry.
I'm trying to do the thing, I'm not good at it already.
I know, it feels, you're selling out, Girk. You're such a sellout.
I hate it so much. You have no idea how much this morally impedes me.
Oh yeah. Well, Ron even volunteered to hop up here to read out questions.
You didn't say
Artsy
smash
voice
the
is
like
pretty
button.
cool.
Whatever form of violence you want to commit on the like button, feel free. It doesn't have to be specific. You can pummel it. You can smash it. You can
pound it.
You could abrade it. Yeah, you could pound it.
Palpate it. Palpate that like button, folks.
So there are. Now this page, it's got a bunch of charts and tools, and it seems kind of like bewildering, and I'm going to make it even more complicated now. And I'm going to tell you that there's information on this page that is not readily apparent by just clicking buttons. But I will also say at the same time that if you really learn all of this, all of options pricing, you don't necessarily need to use a whole lot of other tools. Volatility is awesome. It's a marketable product, so you can buy and you can sell it. It's fun. It's real fun. It's got a lot of like really strict rules that kind of surround it, where if volatility gets too high, it's going to mean revert. If it gets too low, it's going to go up. And these things are inherent mechanically to how options are priced, and so there's a lot of edge in volatility as far as trading is concerned. And so, understanding market structure and positioning and also understanding how dealers are pricing that structure and positioning is very important for designing trades, making good trades, and making timely trades.
I mean, and to expand on that, it's investment strategies too, because investment strategies involve making trades. So
yes, at some point in any investment, you have to trade an asset, usually cash for a stock. But this can also be very good for put selling, which is a key aspect of buy and hold investment is, selling puts, collecting premium while you're waiting to buy the stock at the price you want to buy it at. That can be a really good way of, locking up cash to buy something you want, but still making a yield on that cash over time instead of just, dumping that cash into the stock at a price that you don't really want it at and then kind of suffering the downside. And so, a lot of very famous long-term investors, like the guy who's the head of the Magellan Fund and even Warren Buffett, sells puts. It's a great way of ensuring that your buy-in price is locked in, but you continue to make yield on the cash that you're holding in reserve. And so this is really important for all of that. And I guess I want to kind of go over how. One of the most important things on this page that we talk about a lot over in my Discord, and like I talk about it almost every night, is something called volatility return premium. And this is not displayed here anywhere on the page, although in the future it will be.
Kirk refers to it as VRP. Okay, yeah, you wrote it. Sorry.
Yeah, I call it VRP, and I'll usually describe it as VRP 10, 30, 60, 90 over the time frames that we're looking at. But what VRP is it's the spread between implied volatility and historic volatility. And basically what VRP tells you is it worth selling options or is it worth buying options? So if implied volatility is greater than historic volatility, it indicates that options are overpriced relative to their historic performance. And so IV greater, HV less will yield you a positive VRP. Now, if IV is less than I can just write these on the same line. IV less than HV. This tells you that you have a negative VRP. And that tells you that options are underpriced relative to their historic volatility. And so it is advantageous to buy them. And then the positiveness or negativeness of that spread gives you even more information. So, and you can look at that, how much that diverges over time. And this can tell you a lot about where people in that market, because each options chain is its own individual market, separate kind of from everything else. It tells you how people in that market will react to those premiums being at certain levels. And if you look at those spreads over time, you will see that those spreads are mean reverting. So when options are underpriced, they will then become priced fairly and or overpriced. And if they're overpriced over time, they will become, priced fairly or become even underpriced again. And you can trade the ebb and flow of that premium. And if that premium is very, very positive, it means that, when you're selling options, you're taking very little risk. When that premium's very, very negative, if you're buying options, you're taking very little risk. And fortunately for us here, we have that broken into 10, 30, 60, and 90-day baskets. So you can even cross compare across, the different tenors, where premiums exist on the IV curve out into the future, and you can target specific time ranges for, like right now, I think we have a situation where VRP 10 in the front basket is positive, slightly, just a little bit positive, but VRP 30 is negative, which is telling you that it's advantageous to sell the front and buy the back. Because the back options in that time frame and across the 10 to the 30 are negative return premium, and the front options are positive return premium, which means which literally builds an options position for you. It tells you that you can sell the front to finance buying the back.
And I think this comes full circle back to the gauges. Right, you can do this at a glance with the gauges.
Yeah, they do help with that quite a bit. And so, and that means you would sell a near term put, buy a longer dated put, or sell a near term call, buy a longer dated call, and then you can even adjust that further by using skew to see where the advantage lies. What's the market betting on? Is it betting up or betting down? And then you can modify the position via choosing puts or calls to pick your direction based off of, the direction everyone else is picking in the market, because it's telling you all of that information. So right.
The contrapositive holds too, right?
Yes,
it's not just, you doing a directional play this way. You can do an anti-directional play this way. If you are a put seller, you can use this to hedge your put as well if you wanted to define your risk, because maybe you're not exactly super thrilled about selling or buying Apple at, let's say, 240, right? You can define your risk to the downside if you want to get a better price on your entry.
Yeah, and this promotes great diagonal selling, where you sell the front put, but you buy the back put to hedge your front put sales. So you're selling a put at the front, every say 3 to 5 days, and then you're holding a 30 DTE put that protects your downside exposure, and also gives you downside convexity. So what this does is it lets you, you can kind of keep selling these puts over time, and eventually you'll make up the cost of this 30 DTE put. And you can pick levels in the market where your trade is invalidated or whatever. But say you wake up the next morning and your sold put is now $30 in the money. Your 30 DTE put is going to cover a bunch of that loss for you. And so you're not taking as much risk in selling these puts as you would be, just selling them naked, or selling a spread, like a vertical spread where you have your risk is fixed, but it's you don't have any downside exposure at all. It's just once it slips, you lose the money. End of the story, which is good for other situations. Right now, buying call debits is very good because the market's kind of just grinding up slowly, and you gotta buy calls a little cheaper than you would otherwise. But this kind of helps build the best position for the surface, and you really want any options positions you take to benefit in some way from this edge that the market makers are giving you via pricing. And so if you can find that edge, identify it with these tools where it's available, then you can better improve the statistical probability of your options position working in your favor, which is literally what edge is. So
your options or your long positions, I mean, it's time in the market beats timing the market, but at the same time, recognizing opportunity in the market is everything.
And recognizing risk. If you're long a stock and you don't trade options at all, but you see that the skew on that stock is diving while IV is flat in the same tenor, that's a big warning sign that may come well before price falls. If everybody in the market suddenly starts bidding up puts and skew is falling rapidly, spot's still flat, that tells you ahead of time that the price of that stock is very likely to drop, or at least a lot of people in that market are betting that the price of that stock is going down. And that could give you time to hedge your long position. It could give you time to buy some in the money puts and protect your upside. It can give you time to sell in the money calls. There's a lot of options there for managing long term risk in a position, but it can tell you how to manage that, and also maybe indicate when to manage that as well.
Yeah, it's it's hard to overstate how fundamental IV is to everything else, because it is a fundamental quantity. So, I mean, in math courses, they talk about fundamental things, right? And those, and when your professor talks about them, they emphasize so much, this is a fundamental thing, right? IV is the exact same way. It is so fundamental to your understanding of how option pricing sort of affects the Greeks, those sorts of things. Those are the they're all built on this. So really definitely pay attention to all of the different parts of this page, because they are the foundation upon which delta, gamma, vega, charm, speed, it's the foundation upon which they're all built. So
yeah,
it's a very amazing page. This is very cool data.
Some
Term
other
structure I love.
Some other fun shit you can do that I mess around with and you can work on your own or try to perfect, I guess. We want to talk about how we use this to trade, right? And one thing you can do is the term structure. We kind of talked about how you can kind of see that forward path where a spot is expected to be over time, and you can use that to sell calendar spreads out of the money, and see if the market's expectation is correct. And if you're selling calendars within the direction of that expectation, the probability that you are going to be right is weighted in your favor. And you can open, far dated calendar spreads very, very cheaply. And targeting specific strikes, especially out of the money, they're extremely cheap. And if you're correct and price arrives where the market has priced it to arrive at the date and strike where the market has priced that, you will, obviously make the most money possible off of that position. And so that should probably be something that's factored into strategies where you're selling theta over time, and you're selling vol. And so that can be really important. I kind of told you guys how you can like map VRP. You can also look for like kind of wrinkles in liquidity on more illiquid stocks. You're not going to find too many of them on the S&P, but there are a couple here. There's obviously like kind of like one here down in like the 5,800 range and another one out here, where you can kind of see where areas where you have distortions due to supply and demand or low liquidity. And that's, those targets can be where like flies or calendars or like broken wing kind of strategies can be really advantageous. Especially if you can get, well, hopefully in the next version of this we can zoom in on this a bit more. But you can choose the expiries using all of these kind of forward looking tools at the surface. You can filter premium selling setups with the implied move. We're not really to these yet, but we do have a volatility exposure or like a volatility filter that measures the 10, 30 day, 60 day, 90 day, basically like positive or negative VRPs. And so you can see
it's
which
exactly the positive, negative, or it's exactly the VRPs.
Yeah. And so this will tell you, what stocks and that we have on the service have the most incentive to buy or the most incentive to sell over any given time frame. And so that's a pretty cool way that this kind of filters out to all the rest of our stuff. We already talked about how you can advantageously use that pricing to finance your positioning and reduce risk. I think you can separate the idea of vol going up from the idea of fear going up, because a time series chart is going to allow you to kind of distinguish what is a general rise in at the money vol versus a more like aggressive rise or fall and skew. That way, you can see if like it's really sentiment driven or it's near term driven or it's long term, like a long term thing. Is skew consistently declining over a long period of time? So people are getting progressively more and more bearish, or did, skew just snap down, but Ivy hasn't really followed suit? And, that's maybe an indication that there was a moment of panic, but it's faded. And that can give you a lot of information about, if a stock falls 10% overnight, but, then skew snaps back to the upside, that's telling you, everyone's buying the shit out of that dip. Maybe it was just near-term panic, and it's probably going to mean revert back to the price it was at previously. And so, these are all trades. These are all methods of improving trades. And I feel like I can't emphasize enough how much important information is on this page. And you guys can always go in and look at the docs, obviously, and all of these tools, and the information behind these tools is kind of spelled out in detail for you guys as well.
Yeah, no, absolutely. Read the docs. We always say that in every single one of these roundtables. Read the docs.
At GammaStrike.com/docs.
That's right. app.gammastrike.com/docs. It is absolutely awesome. The docs are written by JFresh. He is a wizard and kind of a weirdo. But yeah, IV is once again, it's foundational. It is the basis upon which everything else is built. So this page itself is super good. And not only that, like Rick alluded to, right now what we're looking at is like 1998 Barry Bonds on the Pirates. Okay, we're about to get juiced up, giant head, barrel chested Barry Bonds in the goddamn Giants in 2004. Okay, this thing is about to get a serious glow up, and it's going to be absolutely bitchin'. But as it stands today, it is still a very cool and valuable tool for not only options traders, but for anybody who's looking to go long a stock and they want to see where sentiment is at for all the big boys. It's just a really cool tool. I mean, I love it. It's really cool. Sorry about the baseball reference, Kirk. I know you don't know what that is, but Barry Bonds.
I know who Barry Bonds is. I mean, I was like a child back then, so I was more into sports unwillingly.
Yeah, he could in 2004 he could pop a car tire with his fist.
I believe that.
He was so juiced up, it was unbelievable. But yeah. So, do you think it's that time, Girk? Do you think it's time for us?
I think it's time to start taking some questions from the audience.
So wait, Girk, before we do that,
What?
Ron proposed.
What did he propose?
He proposed hopping up here to read off the questions to us. How do you feel about that? A third voice.
Wait, well, as long as Ron promises does not say anything else but the question and the source of the question, if no other words, and I will agree to it, because I already had to listen to him when we recorded Vol Stars. I'm still pissed off from that event.
I wasn't there for it. I should go listen to it.
Yeah, we can
see how terribly
we can invite Ron up here if he'd raise his hand. I can't just put you. Can I just put him on the stage? Oh my god! Can I just put people on the stage?
That's terrifying.
I think I can't. No, I can't. I can move him to other channels, but it doesn't appear that I can just force him to be up here with us. Oh my god! If I could do that, I would do that to so many people.
Just throw him up here.
Oh, he left. He left. It doesn't matter.
He's scared. There's a ban button there too.
I'm going to invite him to speak. I don't like that they give people a choice. I really, really would love to be able to just drag and drop people up here.
Just put him in the spot.
Just put him in the hot seat, like right. Sinbad with his first time hearing about any docs, despite being subscribed to the service for months.
Right. Just drag him up here and absolutely lambast him.
Yes. Which he's probably into. He does own GME, so.
You know what we should do is whenever you click anywhere on the screen for the website, it should just take you to the docs.
Have you been on GammaStrike for years? Has GammaStrike been around for years? My sense of time is fucked.
Dude. Fuck, dude. I gotta start counting my gray hairs again.
Do you have any?
I bet Ron's poured himself a fucking whiskey or something.
I've got like 4 or 5, but I'm really waiting for the Silver Fox stage.
Ah, yes. Where you've got more pepper to your salt.
No. I don't want any pepper.
Oh, I see. Yeah. So you're just gonna just dunk your head in black ink.
No, I said no pepper, all salt. What the? Never mind.
Oh, no pepper. Sorry, I said salt. My bad.
It's okay. Now I know why your food looks so bad.
Fuck you. Oh Christ, Ron, are you okay? Are you gonna make it?
Yeah, I can ask the questions, and Girk, I'll abide by your term.
Thanks, Ron.
Well,
it's not that I don't want to hear your voice. I just don't want to hear your voice.
He technically already violated the terms, so now we're fighting.
Yeah, that's okay. But it was an initial introductory violation of the terms, which is the terms had not yet been agreed to. They had to be agreed to per the sentence that he spoke. And so the agreement is not part of the condition.
Wait, so does that mean the agreement is now in effect?
Yes.
Okay. Ron, hit us with questions.
All right. Are we starting with the Volstar leftover questions or the roundtable questions?
Just let's do the roundtable questions, and then if we're tired, we'll just do Volstar questions on Volstars.
All right. So the first one is, I'm not sure what contango means, and at this point, I'm afraid to ask.
Contango?
Contango, sorry.
Contango. Good old contango. Well, contango is where so let's look at the term structure, okay? This is just to use as an analogy, okay? So contango is when the future price of an asset is higher than the actual price of an asset. So the way the mnemonic for me is when you're doing the tango, there's a positive outlook for your future. Right? So
That's horrible. Is that how you remember things?
fuck you. Yes. God damn it. Yeah, so contango is just where the future, so like if you like, let's just imagine the price for watermelons, right? You buy a watermelon today, it costs, let's just say $1 for a watermelon. But the futures contract for a watermelon is at $2. The watermelon price is in contango. That's to be compared with backwardation. You're taking a step back in price.
Yeah.
Where if you could buy $1 watermelon today and it's 50 cents, 30 days from now, that would be backwardation.
Yeah. Contango is like calm now, but higher priced later. And backwardation is kind of like stress now, prices are lower later. So these are terms that come, largely from like commodities markets, where you can have near term stresses in supply that drive the current price of the commodity up, but that stress is expected to fall off over time. Volatility also works this way, where you get contango and backwardation, where like the recent skerfuffle in Iran, where that drove a lot of volatility into markets, and now it appears it's resolving, and that volatility is coming back out, and the term structure is starting to normalize and move back into contango now, although not very much. But prior to that, it was in backwardation for some time, because the near term risks were greater than the long term risks.
Perfect. All right, here's your next question. What is the difference between SPX, $SPX, and SPXW? They have similar points, but they're just a piece of the whole ETF system, or just another data set of the same thing?
So $SPX, SPX, and SPXW are all actually the same asset. They are all SPX. So we have different expiries on SPX. You have the SPXW chain, and you have the SPX monthly chain. One of them has an expiration every day. Every single day of the week, there is an expiration on the SPXW chain. It is the most near-term liquid chain. And then you have the monthly chain, where people are placing their long-term positioning on SPX and the index. And that's mostly used by institutions. It has an AM expiry. We have an expiry coming up this Friday. And so it's got two separate chains, and one of them has, an expiration every 30 days or, once a month. It's not exactly 30 days. And then the other one has an expiration every single day. And so breaking those apart can be really important, and that's why we do it. We have SPXW that you can look up independently, and SPX that you can look up independently, because most of the short-term price action and positioning is going to be on the SPXW chain throughout any given week, with the exception of a week like this week where you have SPX. And so in order to save people the effort of flipping back and forth between the two chains to look at total exposures and positionings, we created $SPX, which is just an in-house moniker for the combined chains of those two. I will say that there is a bug with it right now, that the implied volatility page for $SPXW is just or a dollar sign SPX is just the same as SPXW. But with the new volatility page updates that we're going to be pushing out in a little while, that'll be fixed. But it does give you combined values for Greek neutrals, for Greeks by strike, for Greeks by expiry. It can give you combined values for OI on the OI Heatmap, and combined values for the gamma curve. So it can be really useful if you want to look at the whole chain. If you want to look at the near term front weighted part of the chain, or if you want to look at the longer term, more heavily weighted aspects of the chain. And so that way, because it's such a heavily traded instrument, and it's so liquid, you can kind of break all those pieces apart or combine them all.
Yeah, that's pretty. It's about that simple. SPXW, W means weekly. SPX doesn't have the W, so it's quarterly. And then dollar sign SPX, just take the two of them and just smush them together and get this beautiful SPX sandwich.
Yeah.
All right. Had a related question. When evaluating volatility for SPX, do you look at the dollar sign SPX and SPXW? Or it sounds like you just answered that, right?
No, I can't hear you.
He can't hear you, Ron.
Let's see.
Scream.
Is this better?
Yeah, that's way better.
Okay. Sorry about that.
Okay. Okay.
Related question to that. When evaluating volatility for SPX, do you look at SPXW, dollar sign SPX, or dollar sign SPX, SPX, or SPXW?
Well, like I said, the dollar sign SPX is broken, but I will say if the market makes big moves, I'll look at the monthly contracts and see what volatility is done there, as well as the weekly contracts. But 99% of the time, my focus is on the weekly contract. Let's say 90% of the time. I'll be a little bit more fair.
All right. Next question. Sorry, go ahead, Dork.
No, you go ahead. I was just saying, yeah.
Cool. All right. Next question is IV10 less than HV10 and 30 was opposite. Why sell the front if IV10 is expected to rise?
Can you repeat it? Or no, it's fine. If you have positive premium, positive VRP, that is incentivizing you to sell options. If you have negative VRP, that is incentivizing you to buy options. So if IV at the VRP at the front, VRP 10 is negative, you want to buy that. VRP, is less negative or positive at the back, you would want to sell that to finance, and then vice versa. If you have negative premium at the front, you want to buy. If you have positive premium at the front, you want to buy. Negative premium at the back, or a positive premium at the back, you want to sell. So anytime VRP is positive, it's incentivizing you to sell options because you have positive premium. Anytime VRP is negative, incentivizes you to buy options. And then, if you're using those across different tenors, that can tell you about how to better finance your options. It's not always great. Like right now, or the last few days, we've had negative at the front and negative at the back. So the 10 and the 30 are both negative, but the 30 is substantially more negative. So it's better to buy the 30-day option and then sell the front option to finance, even though they're both negative, because your spread and your premium is positive because of the way you're setting up buy the back and sell the front. Because your spread is, within your trade is more positive due to the way that you've structured it.
All right. Here's your next one. Is selling uncovered puts on stocks you wouldn't mind owning with a high IV a viable strategy to make money on vol crush? Maybe 30 to 60 DTE? Or is this something I shouldn't do? Thanks in advance.
Well, usually volatility on equities crushes as the price falls. So usually there's not a lot of premium from selling puts on equities. unless you're selling like puts in the money. Usually you get like kind of a shitty premium on them, but cash secure puts are a great way to buy a stock. Usually if you want to sell vol on equities, it's better to sell calls because, generally when volatility is the highest on an equity, it's the calls that are overpriced, not the puts. That does flip at a certain point, that kind of like, vol up, price up behavior. Usually if an equity falls back under its vega neutral level, you'll start to see that change, and puts will start to get way more expensive than calls, and then volatility will go up as the price of the stock moves down. So in those scenarios, but that's a really risky scenario to buy a stock long term, because then the market's betting that the price of the stock is downward trending in the future, not upward trending. So the assumption for almost all equities is that they will go up over time. And when you're in a scenario where puts are rising in price on equities over time, you're in a scenario where the expected value of that stock in the future is zero. So something to consider if selling high volatility puts on equities is that it's very likely that company is being priced to go out of business.
Yeah, definitely. And this, once again, this comes back to using the term structure and the volatility smile and a handy dandy calculator with there's the expected move, the implied move formula is easily attainable. Just look that up.
Ours is a little different.
We've added a pinch of pepper.
So don't expect to use like the at the money straddle assumption and come out with the same value that we have.
Yeah, but it'll give you a rule of thumb, sort of, squinting with your thumb out measurement, where you can sort of see, okay, if I'm selling a put for this stock at this price, right, what's the expected move I am pricing in with this position, with this entry price? Definitely something that's worth considering. And we give you with the IV, we give you the data to kind of go for that.
Cool. Next question. In the docs, there is a mention of the vol surface being used to spot, quote, low liquidity or mispricing. Does that show up as a bump or a valley? Does seeing that as a texture map present any advantage other than a quick glance? The term structure should have a correlation to the valleys, I think. Does the slope or the texture map indicate probability as it approaches the valley or the bump, other than other participants' interest?
So if it's up, there's interest there. If it's down, it's probably a lack of interest. On very illiquid chains, it can be either one. It could simply be that there is just a bad spread at that price between bid and ask. So it really depends somewhat on the liquidity of the underlying. Obviously stocks that are trading very, very high volumes have very, very high interest in their options chains. Most stocks in the like NQ100, for instance, or in the top like 200 stocks of the S&P 500 by market weight, by market cap weight. Almost all of those chains are very liquid, with the exception of a few, but for the most part, I think I can say that. And anything in like the Russell 2K can be all over the place. A lot of it's like sentiment driven. So like the options chains will go from being in a very illiquid state to being in a very liquid state rapidly as market participants gain and lose interest in that stock. And a good way to monitor that, we talked about before a couple episodes ago, over on the Greek neutrals page, where you have total delta on a chain. If the total delta on a chain is extremely low or lower than its average over time, it shows there's not a lot of interest in that chain at that time. But if the total delta in the chain is very high, which is weirdly more negative not more positive, then it's showing that there's a lot of interest in that chain. And so you can use that kind of to double check if you want to look at like the overall liquidity of a chain. But it can be really important to identify those areas where there's pricing imperfections, because maybe you don't want to buy options there, or you do want to buy options there. And generally, uninformed traders will just buy shit at round numbers. They'll be like, oh, I'm going to buy the 6,900 call on the SPX, and that's just what they'll buy. And that's just a psychological thing. Like, people like round numbers. It's easier to understand. And, that's a very like obvious target for everyone. But, that the pricing, because there's so much interest in that strike, the pricing of that strike may not be great. And it may be better to buy like the 6905 or, to buy the 6910 strike. And that's something that you can get out of kind of these pricing imperfections that you see on the Smile, is that you can gain slight advantages when structuring your trade that make your overall trade better. Like, if you can get the 6905 at a discount to the 6900, it can be more advantageous to buy that strike, regardless of the price move. And the price of the underlying moves the same amount, you might make more money off the further out of the money strike, weirdly, because of that pricing imperfection. You're kind of taking advantage of, if you can get a fill, but you're taking advantage of the, the arbitrage there that is present due to illiquidity or demand or lack, or too many people are selling it. That's a big thing in intraday trading, is you see an option that's oversold, and that can be a very valuable buy, because if the price of that option mean reverts, you're going to make hundreds of % on your initial investment.
All right, next question. And it was noted, they said this may have already been covered, but is the skew on equities and index interpreted the same? Skew going down represents puts being priced up for both. Is that correct?
Yes.
Cool. All right, next one. Does GammaStrike give any insight into what delta will drop off at the AM expiry?
So it does. That's not really something we're covering on this episode, but you can go out here and you can go to the SPX contract, which is this, and you can switch this over to expiry instead of strike, and you can look at the net and go to delta, and this will show you exactly how much delta falls off. $306.36 billion worth on the 4:17 a.m. expiry right now. Well, as of market close today, more specifically. We have more numbers after that, but I just put 306.36 billion is enough. I don't need to go all the way out.
Yep.
Awesome. Minor correction on the fourth question we asked. Is selling uncovered puts on stocks you wouldn't mind owning with a high IV percentile a viable strategy? But sounds like we're already clear on that. So,
okay.
All right. Next one is on SPX. The current volatility is kind of mixed up because the market is high as a kite on hopium and ignoring negative news. Would the current volatility favor 30 or 60-day calendar puts, or rather 10, 60, and rolling shorts, short puts every couple of days, depending on the VRP?
So we'll look at VRP at the front is slightly positive. It's oh shit. Sorry, I'm trying to move my mouse here. Looks like it's about 89.89. 0.9. Wait, 0.89? 0.89. So VRP10 is 0.89 positive. And then VRP 30 is significantly more negative. IV 30 is at 1468. And HV 30 is at 1781. Oh, sorry. So it gives us VRP 30 of negative 3.13. And these measurements are called vols. It's not really important, but these are called vols. It's also how you measure spreads in volatility. But anyway, so basically, this is a moderately incentivized back end for buying, and there's a slight incentive to sell on the front, but very slight. Yeah, this is like, barely relevant. And so, you can then, check out skew for those and see what's going on there. Looks like skew's been kind of trending up pretty consistently over the last few days. So it may be that calls are a little overpriced, relative to puts. And so this might incentivize something like sell the front, buy the back. And, you'd probably want to go, sell the call here on the front and then buy the 30-day out call. That's kind of what it's telling you. Puts are still more expensive than calls, but they always are on indexes. So you could also do it the other way as well, but it just depends on what you think is going to happen with market direction. But basically, with VRP 10 with such a tiny premium, I would lean towards being less than 10 DTE. Like I would probably want to be around like 1 to 3 DTE on the sold put, and then probably around 30 on the bot put. If you were to go puts, if you were to go calls, same thing. That's it.
Cool. Next question. Can you use the volatility page to figure out if a strike is more bought or sold?
Yes. Yeah. If I mean, probably not here with SPX, because it's way too liquid. The pricing is very consistent. But
if you say not on SPX,
yeah, but if you find some other stock that's like here that is significantly more illiquid, you can see where interest is. There's a lot of interest down at like 150, but these are clearly being sold, right? Like these should be higher. So remember that when you're looking at this, it's all relative to how the curve should actually be shaped, which is kind of lowest at spot, highest at the edges. So you're looking at these out here, and you're kind of looking at those out that God, this is not easy to draw on a tablet. Like that. You can see like this strike is bought, this is probably sold. These are also maybe far enough out of the money that they're just illiquid, but closer to spot, like this strike right here, that's a little kink there to the downside of where the rest of the IV is, and that that tells you that somebody's probably selling the 225 strike pretty heavily, because the 220 strike and the 230 strike have quite a bit more IV relative to it. And then you can even double down on that, and you can go down here and look at the the 225 strike and see what's going on there. Or look at volume on the 225 strike, right? It doesn't look like there's much. So it might just be a liquid, you know. Looks like most of the volumes. So these might just be more bought, and the 225 strikes just nothing's happening there. So what we're actually seeing is kind of deceptive. This is interesting. So we're seeing that kink that falls like right there in the term structure. And that's because these are just being bought pretty heavily. And nothing's happening with this. It's just illiquid. There's no volume on it at all. But I mean, that in and of itself tells you something. You know, if price were to move up here, and the 220 strike were to go in the money, since there's no interest at 225, it'll be very hard to move up to 230. This will kind of act as like a pin for spot, which is fun. Maybe not the best example of exactly what we were trying to show, but it is an example of how it works in practice.
Cool. All right, here's the next one. So this is related to the uncovered puts question from earlier. They noticed that Microsoft has an IV percentile of 100%, but that was calculated through Thinkorswim's IV percentile calculation. They were just wondering if this changes the answer to the previous question or not.
No. Wait, what was the previous question?
That was the one that said, is selling uncovered puts on stocks you wouldn't mind owning with a high IV percentile a viable strategy to make money on for a vol crush?
Well, you wouldn't want to sell puts. You'd want to sell calls. Oh, yeah, I went over this already. Yeah, you'd want to sell calls for volatility crush, not puts. Because
Well, so
Microsoft's implied vol is very high, which means it's to the upside of its price range, right? It's like, I mean, I think Microsoft's like almost above Gamma Max. Like it's like right at Gamma Max. If you sell puts here, you're buying Microsoft at the highest price it's been at in like the last like 90 days. This is a terrible deal.
Well, it depends on how bullish you are, but I mean, yeah, that's the dude. Look at that Gex, dude. That's crazy.
I know,
Holy
it fucking
shit.
exploded.
No, there's when it comes to earnings and things like that, where you do have some premium just purely out of uncertainty, that can present itself as an opportunity, but it is important to, and that's where these Greeks kind of come into play, as they give you an idea of, okay, now that we know where options are priced, what the premiums are and everything, we roll that up in a big ball and we throw it on the screen. Where are we positioned relative to that pricing? And yeah, like as Girk was saying, I mean, where the premium exists, right? To the downside, it's probably there, especially heading into earnings. But what you're going to have to do to get the yield on the cash, if you end up not getting assigned at this price that, you are committing yourself to, you may end up being at a price that you may not be feeling great about. So yeah. It is. It might be fair if you're a buyer at like 400, but are you a buyer at 400? That's another question.
Yeah, this is kind of where this tool comes in handy with this, is that, if you want to buy a stock long term, this is where delta neutral here is kind of where the options market is saying, like, this is a price we agree is fair over time. Like, so the entire options market is kind of in agreement that Microsoft is worth 377. Microsoft is currently trading at 420. So if you were to sell a put at 410 and price pulls back to the level the options market is kind of indicating, you're taking like a $30 drawdown, $33 drawdown on all of your shares, which is significant. That's a significant hit. And you're probably not going to get a lot of yield for a 410 put. This chain would need to reprice to move much higher than it's at right now, because it's already at gamma max. So you would need to start seeing significantly more interest here to the upside to make this a good buy. Whereas right now, the options market's kind of betting that this is going to come, back down at some point. So I would say this is more akin to buying like here, or buying back here at prior tests of gamma max. And as you can see, those were not good times to buy the stock. However, if you're here in this range trading between gamma neutral and delta neutral, this can be a very advantageous time for selling puts. Because this is where the market, you're buying the stock at a reasonably fair price, which if you look out over time turned out to be true. This was very bad.
Once again, this is the foundation the volatility page, kind of creates. And what you're looking at here is the aggregation of that into some fundamental prices that do tell you, this is, like the green line. It's similar to the green line, but more so the weighted average, right? It's almost like a VWAP version of I. I don't know. I'm gonna have to think about that, but
because if you look at skew on Microsoft right now, like both 30 and 10 day, that's starting to come down, which means puts are starting to price up, but they haven't, right? And right now, we're getting closer to calls being expensive relative to puts. So this is just like not a great time to sell puts. It may be a great time to sell puts if you really desire assignment, but then you have to ask yourself, do I want to own this stock at this price? Because the likelihood of you getting assigned is very high. And you're not getting like a significant amount of premium on these puts. These puts are cheap relative to where they usually are, or where they've been recently.
Yeah. I mean, cool. Yeah. If you're into selling puts on Microsoft, I think that kind of nails it.
All right, and I think this is our last question before we go to the Vol Stars, if you guys are still up for that. But earlier, for the question on using the volatility page to figure out if a strike is more bought or sold, there was just an ask if we could clarify why Girk looked at the volume instead of the OI.
I'm answering it in chat right now. I looked at. I'll answer for everybody on the stream too. OI. So at the end of day, we have two updates in the overnight between market close and market open. And due to calculation times for all of these models, there's a bit of delay from when we get the data to when it's published. But here we have around like 7 p.m. We have an update for the end of day. And then here around 7 a.m. we have an update that is for OI. And so, here at end of day, when we get the closing information, we get price and volume and all of that stuff, but we don't get any clear indication of like what remained on the chain yet. And that comes out in the morning before market open. And so the OI update, depending on the underlying, can make a very big difference in what you're looking at. And mostly what I was looking for was activity on those strikes. I wasn't really looking for what stayed on the chain. And since I'm looking at the closing vol, the market close volatility, and I don't have the OI yet, it was better to look at the volume rather than to look at yesterday's OI in relation to today's vol. Because remember, until the 7 a.m. update, you're still looking at the prior day's close OI. So just a little caveat. It doesn't make a huge difference, but for something like that, where you're specifically looking up the liquidity of a strike, you know, I guess keep this in mind. Kind of getting into the weeds here, but yeah, there's a reason.
Cool. Then we'll get into some Volstars questions.
Okay, hold on.
Go.
Do they relate to GammaStrike?
This first one does.
Okay, cool.
All right. First one here is I don't track option levels and gamma levels at certain strikes frequently. When should I pay attention to certain levels, and what volume is needed to see, either likely a defense or push through? And how do I interpret option flows at key levels?
Okay, well, so key levels are relative to the rest of the chain. So, I mean, big bar, significant, small bar, not significant, relative to the rest of the bars on that chain. So, you remember, each one of these is its own individual market. So, in some markets, 1,000 options at one strike might be really significant, like a very large deviation from the rest of the strikes on the chain. You should pay attention to any large deviation in any closed system. On other chains, you might need 150,000 options in a strike for it to even be noticeable. So there's a lot of variance there between each individual options market. But as far as like determining how big does it need to be to react, bigger than the ones next to it, and you're going to have some effect. I mean, unless it's like you have 3 options on one strike and 2 on the next, then I mean the options chain on that stock probably just doesn't matter at all. But you can go and look at exactly how much delta. You can go to delta by strike and you can look at how much delta specifically is at a strike, and that can you can 50 delta is the at the money price of the underlying rate. You can kind of work with that. It could like tell you how much like how many shares of value are at that strike. Doric, do you wanna add anything to that question? It's kind of asked weird. I'm trying to think of a way to like answer more of it, but it's kind of a weird question.
Well, it's a weird mixture of day trading and the options levels from the end of day data. So volume needed to see likely defense or a push through. I mean, has less to do with volume and more to do with IV. I mean, you can see a lot of volume on an out of the money call, but especially when you're testing it from the downside, right, to try to push through, you'll see a bunch of volume on the call potentially, but if the price of the call drops, then clearly it's sold. So I mean, yeah, I think you kind of nailed it though. You can see those key levels and you can make interpretations of them based on the data you're seeing when you're trying to determine whether or not you're seeing a defense or an offense, because it is a zero-sum game. But yeah, it's a pretty nebulous question. I think you kind of nailed it.
Okay.
Cool. Next one here is, sup guys, can you talk about strategies for individuals with portfolio manager data? Only I can't actively manage my positions on an intraday basis. I can only do so on SPY, QQQ, 75 plus delta contract, directional plays. I'm in no rush to trade.
Yeah, okay. So I mean this is the story for most people, and the portfolio manager side of GammaStrike is specifically designed with this in mind, is that most people have jobs and aren't watching the market actively 9 a.m. to 4 p.m. every single day. And so I mean I know earlier in this episode we discussed a bunch of strategies around volatility, none of which are short term. Those are all, and we don't have a short term vol indicator. Like we don't have like a 3-day volatility indicator, 0 DT volatility indicator. So, the volatility plays we're looking at are all, 10, 30 days. Management of any trade can occur on any day, which is something to keep in mind. There's no positions that are truly like set it and forget it unless you are, absolutely okay with the max loss of that position. But there are some things, we've discussed in the past, selling puts on downside moves below gamma neutral. We've discussed in the past selling calls above gamma max. We've discussed today calendar and diagonal spreads that take advantage of distortions in the volatility surface and in the front volatility surface. You can do that in the back volatility surface as well, for even arguably even more stable volatility trades. And so those are all ways of, taking advantage of positioning and, how the market behaves mechanically over longer periods of time. I think we took a moment earlier in this episode also to discuss where put selling is advantageous and where it's not. If you just want to get cheaper prices on the stocks you buy and make a yield off of it, I think we outlined that as well. And I mean, there are literally thousands of other trades that are possible over long periods of time. I would argue that the vast majority of trading that occurs does not occur on an intraday basis. But there does need to be planning for managing those trades as needed. And so, it's always a very good idea to define the risk in your trade, whether that be via technical levels, whether that be via, options positioning, or whether that's via, how the curve is pricing options. Because you can use any of those or all of them to define the risk in your trade. And that's, another a big advantage of these tools, obviously.
Yeah, trades are made during the trading day, but like Girk said, a vast majority of those trades are based on a decision that was made on a trade that, or a trading strategy that spans multiple days, months, years. So yeah, that's usually when you, especially for directional plays, so you're doing 75 plus delta, so you're trading in the money contracts. I mean, really you're essentially just long and short the stock if you have enough theta. So, and if you're in no rush, I mean, that tells me, especially with SPY and QQQ, that you're doing longer dated trades with essentially a long short strategy. I mean, there's not a whole lot to elaborate on there necessarily, but you can still come up with thresholds for those decisions you're going to make when you are managing those positions. Not on an intraday basis necessarily, but when you take stock, when you can look and you see what's going on, right? This will help you, get a sort of mile high view and determine whether or not your trade has been invalidated or anything like that.
I mean, that's if I were trading exactly like that, I mean, I would probably pop this open once a night and just check the stocks that I have trades open on and make sure that the larger macro trends, like the shit you see on this page that we have on the screen right now, things out in like 60 and 90 day volatility, nothing's changing too dramatically, and then close it. But if I saw a big move or a big shift, or the stock had hit, gamma max or fallen below gamma neutral, and or some longer term indicator of relevant price action, then I would think, oh, maybe tomorrow I need to pay attention to this trade, and I think the rest of the time, I would probably just like not really be paying too much attention to it.
Yeah. It doesn't
Like if I were,
if
I were like a Microsoft bull, and I were looking at this kind of period where it's downtrending, maybe I'd be buying like 90 or 180 day calls, or maybe opening, like selling a put and buying a call, and getting that exposure while still picking up some put like stock at cheaper prices if it were available, as it traded around gamma neutral over delta neutral, back under gamma neutral. Those would have been all times when I would have been kind of like trying to buy the dip, basically. And then now that it's at gamma max, like there's several days where you would have been just like, oh, awesome, it's going up. But now that it's hit gamma max, I might want to like maybe sell some covered calls on it, or take like a calendar spread on an upside strike, or maybe try to play the stock trading flat for a little while, or some of the short-term bullishness to kind of die down, and maybe I would sell like an at the money call, or call spreads, that kind of thing. Or maybe I would want to protect the increase in the price of the thing I'm buying, and I would want to buy a put out above delta neutral, or gamma max rather, for like 180 days, and pick up some protective puts in case it does fall. And then, if it doesn't, and the options chain continues to grow, and, gamma max continues to slide up, I'd close that protective put, that kind of thing. So it's just the idea of, it gives you a lot of information about management, not just where to enter, like where to buy and sell. So you get both, but I think day to day I would be checking it to check my positions for any needed management.
Right. And I think you're touching on, rather than just being purely long, short, neutral, you're touching on how you can potentially use our tools to elaborate on a position that may have started long or short. But there's an opportunity for money to still be made without just closing a position, or where losses can perhaps be mitigated without just entirely closing a position.
Yeah.
Yeah.
I mean, the fact of the matter is, stocks go up and stocks go down. And you don't want to just be in them the whole period of time. It's not, over time, yes, they will increase, but there is you don't have to be, you don't have to focus all the way down to the minutia of each intraday session. But there are major trends in stocks where, they go up very, very rapidly over a period of time. That interest kind of cools, and those are periods where you want to protect the money that you've made. And that's, doesn't mean you need to sell the underlying, but it may mean that, you want to sell some covered calls in case the stock got a little too enthusiastic and you think it needs to pull back a little. And that way, even if it pulls back a little, you made some yield that covers some of your loss from those, more exuberant highs. And that kind of like smaller management would, I think if done properly, and not, micromanaged, of course, but just kind of more macro management of your portfolio, if you're self-directed, can really show up in your year-over-year yields, like very significantly. I mean, most people are banking that they'll make 8 to 12% a year on the S&P every year, hopefully, and then any drawdown of significance will resolve itself in 10 years. But I feel like that's, that's kind of just like the worst case scenario. And so why not try to do a little better? I mean, even just buying protective puts when stocks are at new highs that you own can, drastically improve that 8 to 12% a year. Like you could end up with, like 16 to 18% a year just because you buy protective puts when stocks, the stocks you own hit gamma max.
And it definitely, this comes down to two, like things like, and these are tools that are further on the horizon, but things like portfolio management, understanding your real cost basis on a position. If you you own 100 shares of company X and at like $1 and you sell enough puts, and they don't get assigned, how does that change your cost basis? That kind of things. I mean, if you track that, and someone who does this religiously, who I want to give a shout out to for this because it's it's the utmost compliment, is Atomic.
Yeah.
Atomic pays very close attention to his cost basis, and he knows when his cost basis is low enough that the holy grail is a negative cost basis, because it means the company could go out of business and you still made money on it.
Yep.
So
I got
it all ties into that.
I very famously, I mean, for everybody here who was around back when I first started doing all of this, I was buying GameStop at 150, 125 a share, pre split, of course, but and after like 3 years had gotten my cost basis down to like negative 13. I think it was like negative $13 and change. And so, a lot of people, I'm not still buying GameStop. Gross. And so people like love to give me shit because I sold at 17, but for selling at 17 for me was the same as selling at 30 if I had a $0 cost basis. So, so if I'd gotten the stock for free, I sold it at $30, which I was fine with.
Yeah. So that's another small aspect of this too to kind of take into consideration. I know we've flown off the rails of options a bit, but it all kind of ties together because a well-managed portfolio is not 100% options,
All right, we got one last question.
Cool.
Can I get the exact GEX value per strike? Like, would that be available within the Greeks by Strike dashboard by like hovering or toolbar tips?
Yep.
Or is that something we could get as a feature?
It is available at each strike. You just mouse over it.
It's right there, right in front of your face.
And you can even look at the summed GEX exposure at each strike as price moves up and down here on the gamma curve as well. So you can look at it in totality, or you can look at it strike by strike, but you can get the values by just mousing over them. And you can separate that into puts and calls, or you can look at the net.
Boom.
Boom.
Whew. Look at that. We started bouncing around all the tools again. It just happens naturally when you play with these things. You start somewhere and then it just naturally kind of sends you off on a little goose chase on.
It's almost like somebody who spends 20 hours a day trading and doing stock analysis built
it. It's fun. It's fun. It's an easy way to get down into a rabbit hole for sure, but there's definitely I think the volatility page especially lends itself, that and the Greeks page, they both lend themselves to, at a glance, what's the sentiment in the market? How are things priced relative to where speculators are pricing things? I think those two are kind of like, peanut butter and jelly.
You can even dive deeper into a single strike, and you can look at how that gamma is distributed over time. You click on it, so you can mouse over it and you get the GEX value, and then you can click on it and you get the open interest at each expiry and the gamma of that open interest.
Pretty cool stuff.
Yeah.
Yeah.
You can also adjust the expiry here.
Whoa! Look at our Greeks video.
Yeah. Watch
We did
the
a
Greeks
whole
post.
thing on this that we're gonna do so much better on because we were fresh, we were hot. We did that one.
We were.
Yeah, now we're like deep into this. We're like an hour and 50 minutes into this one, so it's, you know, I'm not cooked. I'm medium rare. Yeah. So that's, we once again we flew off the rails a little bit, but that's that's our volatility page in a nutshell. There's a lot of useful tools for day traders, long-term traders, DCA, VU and chill type, all those kinds of folks. You can get some useful information off this guy.
Yep.
I mean,
so thank you everybody for tuning in. It's about 10 o'clock now, so we're going to call this a wrap. And Ron, I was just fucking with you. You could have been talking this whole time.
Oh man, nah, I'm good.
All right, I will. We'll see you guys at the next one. Later.
Thank you guys.